All right, reading 48, Introduction to Industry and Company Analysis, Learning Outcomes. The candidate should be able to explain the use of industry analysis and relation of industry analysis and to company analysis, compare methods by which companies can be grouped, current industry classification systems, and classify a company given a description of its activities and the classification system. Explain the factors that affect the sensitivity of a company to the business cycle and the use of limitations of industry and company descriptions such as growth and defensive and cyclical. Explain how a company's industry classification can be used to identify potential peer group for equity valuation. Describe the elements that need to be covered in a thorough industry analysis. Describe the principles of strategic analysis of an industry. Explain the effects of barriers of entry, industry concentration, industry capacity, and market share stability on pricing power and price competition. Describe industry life cycle models. Classify an industry as to life cycle stages and describe limitations of life cycle concepts in forecasting industry performance. Compare characteristics of describe the elements that should be covered in a thorough company analysis. Introduction, industry analysis, the analysis of a specific branch of manufacturing, service, or trade. Understanding the industry in which a company operates provides an essential framework for the analysis of the individual company. That is, company analysis, equity analysis, and credit analysis are often conducted by analysts who concentrate on one or several industries, which result in synergies. Oh, I love that word, synergies, and efficiencies in gathering and interpreting information after discussing. Yeah. Okay, so tell me ways in which you could value a company or value an enterprise is one of the common investment banking interview questions. In fact, I also got that question. Okay, use of industry analysis. Industry analysis is useful in a number of investing applications that make use of fundamental analysis. Its uses include the following: understanding a company's business and business environment, identifying activity, equity investment opportunities, portfolio performance attribution. Later in this reading, we explore the constant consideration involved in understanding a company's business and business environment. The next section that addresses how companies may be grouped into industries. Approaches to identifying similar companies. Industry classification attempts to place companies into groups on the basis of commonalities. In the following section, we discuss the three major approaches to industry classification: product and or service supplied, business cycle sensitivities, and statistical similarities. Okay. Introductory industry classification systems. As well-designed classification systems often serve as a useful starting point for industry analysis. It allows analysts to compare industry trends to relative valuations among companies in a group. Classification systems that take a global perspective enable portfolio managers to research and analysts to make global comparisons of companies in the same industry. For example, given the global nature of automobile industries, thorough analysis of the industry will include auto companies from many different countries and regions of the world. Commercial industry classification systems. Many index providers such as the Standard & Poor's, MSCI, Russell Investments, and Dow Jones and FTSE classify companies in their equity indexes into industry groupings. Most classifications schemes use these index providers contain multiple levels of classifications that start on the broadest level of the general sector grouping, then in several further steps subdivide or disaggregate the sector into more granular sub-industry groups. Global Industry Classification Standards, GICS, was jointly developed by Standard & Poor and MSCI Barra, two of the largest providers of global equity indexes. In 1999. As the name implies, GICS was designed to facilitate global comparisons of industries. It classifies companies in both developed and developing economies. Each company is assigned to a sub-industry. In a sub-industry according to the principal business activities. Each sub-industry belongs to a particular industry. Each industry belongs to an industry group, and each group belongs to a sector. the Russell Global Sector, the Industry Classification Benchmark, and the descriptions are all ways that which companies can be broken down into ways in which ways in which companies and stocks or equity are grouped into different sectors. So for example, an index or an index fund may be better able to group these different elements or different enterprises together. Description of representative sectors: basic materials and processing, consumer discretionary, consumer staples, energy, financial services, healthcare. So these are just examples of different sectors and different groupings that industries could be grouped in. Healthcare, industrial, producer, durables, technology, telecommunications, utilities. To classify a company accurately in a particular classification schemes requires definition of the classification categories, a statement about the criteria used in classification, and detailed information about the subject company. Example 2 introduces an exercise in such classification and addressing the question. The reader can make use of widely applicable sector descriptions, just given the familiarity and with available business providers and services. Okay. Governmental industry classification systems. A number of classification systems used by various governmental agencies today organize statistical data according to the type of industrial or economic activity. A common goal of each government classification system is to facilitate the comparison of data both over time and among countries that use the same system. Continuality of the data is critical to the measurement of evaluation of company performance over time. International Standard Industrial Classification of All Economic Activity. The International Standard Classification of All Economic Activity was adopted by the UN in 1948 to address the need for international comparability of economic statistics. ISIC classifies entities into various categories on the basis of principal type of economic activity and the entity performs. ISIC is organized into 11 categories, 21 sections, and 88 divisions. 233 groups and more than 400 classes, according to the United Nations. A majority of the countries around the world have either used ISIC after national activity classification system or have developed national classification systems derived from ISIC. Some of the organizations currently using the ISIC are the UN and specialized agencies and IMF, the World Bank, and other international bodies. Statistical classifications of economic activities in European Community. So they also have their own. It's called the statistical classification of economic activity in the European Community. Australian New Zealand Standard Industrial Classification. The Australian New Zealand Standard Industrial Classification, or the ANZSC, was jointly developed by Australian Bureau of Statistics and Statistics New Zealand in 1993 to facilitate comparison of industry statistics of two countries and comparisons. I mean, two countries, they have freedom, they have free flow of labor, free flow of capital, free trade, and they also, so is that two countries? It's more of like a monetary union, but just without the monetary union. It's a customs union. In comparison with which with the rest of the world, international comparability was achieved by aligning ANZSC with the international standards used by ISIC. ANZSC has a structure comprising 5 levels, namely divisions, subdivisions, group classes, and at the most granular level, subclasses in New Zealand only. North America has its own strength and weakness of the current system. Unlike commercial classification systems, most government systems do not disclose information about specific businesses or companies, so an analyst cannot know all of the constituents of a particular category. For example, in the United States, federal law prohibits the Census Bureau from disclosing individual company activities, so their non-NIC SIC codes are unknown. Most government and commercial classification systems are reviewed and, if necessary, updated from time to time. Generally, commercial classification systems are addressed more frequently than government classification systems, which may be updated only every 5 years or so, and NIC, for example, is renewed for potential revisions every 5 years. Government classification systems generally do not distinguish between small and large businesses, between for-profit and not-for-profit organizations, or between public and private companies. Any limitation or current system is the narrowest classification unit assigned to a company generally cannot be assumed to be its peer group. For the purposes of detailed fundamental comparisons or valuations, a peer group is a group of companies engaged in similar business activities whose economic and valuations are influenced by closely related factors. Comparisons of a company in relation to a well-defined peer group can provide valuable insight into the company's performance and its relative valuations. Constructing a peer group. The construction of a peer group is a subjective process. The result often differs significantly from even the most narrowly defined categories. Steps to constructing a preliminary list of peer companies: examine commercial classification systems, review the subject company's annual reports for discussion of a comparative environment. Companies frequently cite specific competitors. Review competitors' annual reports to identify some potential comparable companies. Review industry trade publications to identify comparable companies. Confirm that each comparable company derives a significant portion of its revenue and operating profit from a business activity similar to the primary business of a subject company. Questions that may improve the list of peer companies: what proportion of revenue and operating profits derive from business activities in a similar subject company? Does a potential peer company face a demand environment similar to that of the subject company? Does the potential company have a finance subsidiary? And questions such as this really help in the classification and actually grouping of different equities into a common sector. Okay. Describing and analyzing an industry. In their works, analysts study statistical relationship between industry trends and a range of economic and business variables. Analysts use economic, industry, and business publications, the internet resources as sources of information. They also seek information from industry associations, from the individual subject companies they are analyzing, and from the company's competitors. Analysts attempt to develop practical, reliable industry forecasts by using various approaches to forecasting. They often estimate a range of projections for a variable reflecting various possible scenarios. Analysts may seek to compare their projections with the projections of other analysts, partly to study differences in methodology and conclusions, but also to identify differences between their forecasts and consensus forecasts. These latter differences are extremely important for uncovering investment opportunities because to the basis for superior investment performance, the forecast for a relevant variable must be both current and sufficiently different from the consensus reflecting the price of publicly traded companies. Note that although some information of analysts' revenue projections, EPS estimates, and ratings are accessible in some markets, investment managers and analysts also examine industry performance in relation to other industries, in relation to identify industries with superior/inferior returns, and over time to determine the degree of consistency, stability, and risk in the returns and industry over time. The objective of this analysis is to identify industries that offer the highest potential for investment returns on a risk-adjusted basis. The investment time horizon can be either long or short, as in the case for rotation strategies, in which portfolios are rotated into the industry group that are expected to benefit from the next stage in the business cycle. Often analysts examine strategic groups almost as separate industries within industries. Criteria for selecting a strategic group might include the complexity of product or service, its mode of delivery, and barriers of entries. Analysts often consider to classify industries according to their industry life cycle stage. The analyst determines whether an industry is in the embryonic growth, shake out, mature, or declining stage of the industry life cycle. During the stage of the life cycle, the product or industry its positions on the experience curves is often analyzed. The experience curve shows direct cost per unit of goods or services produced or delivered as a typically declining function of cumulative output. The curve declines businesses As the utilization of capital equipment increases, fixed costs, administrative overhead, advertising, etc., are spent over a larger number of units of production because of improvements in labor efficiency and management of facilities, and because of advances in production methods and product design. Examples exist in virtually all industries, but the experience curve is especially important in industries with high fixed overhead costs and or repetitive production operations. And Exhibit 2 provides a framework designed to help analysts check that they have considered the range of forces that may affect the evaluation of an industry. Okay, so macroeconomic influence, governmental influence, social influence, technological influence, and demographic influence concerns the new entrant threat and the product service substitution threat. And they are also attacked on both sides by superior bargaining forces and customer bargaining forces. So, yeah. This is a framework for industry analysis. Principles of strategic analysis. When analyzing an industry, the analyst must recognize that economic fundamentals can vary markedly among industries. Some industries are highly competitive, with most players struggling to earn adequate returns on capital, whereas other industries have attractive characteristics that allow almost all industry participants to generate healthy profits. Depending on the market structure, either a perfect competition, oligopoly, monopolistic competition, or monopoly, as we have previously learned in the economics section of the theory of the firm. Exhibit 3 makes the point graphically. It shows the average spread between returns on invested capital, ROIC, and it's basically ROI, but ROIC makes it sound more like ROC, which is the Republic of China, which is Taiwan, whatever, and the cost of capital of 54 industries from 2006 through 2008 industries earnings. So as can be seen, some industries struggle to generate positive economic returns even during periods of synchronized global growth, while other industries did very well in earnings such returns. Wow, biotechnology suffering hard. What is this? Construction machinery. That's surprising. I actually thought tech would be more right here, like data networking, money management, like the Goldman Sachs is. Oh, tobacco doing really well. Software doing quite good. Okay, that's quite interesting. Coal just breaking even. Food just breaking even. That's surprising. Air transport, gold and silver. Yeah. Forestry, well, that's pretty funny. Differing comparative environments are often tied to structural attributes of industry, which is one reason industry analysts is vital complement to company analysts, and to thoroughly analyze a company itself, the analyst needs to understand the context in which the company operates. Needless to say, industry analysts must be forward-looking. Many of the industries in Exhibit 3 were very different 10 to 15 years ago and would have been placed differently with respect to value creation. Many will look very different 10 to 15 years from now. Well, that's of course. Analysts of the competitive environment, with an emphasis in the implications of environment for corporate strategy, is known as strategic analysis. Michael Porter's 5 Forces framework is a classic starting point for strategic analysis, although it was originally aimed to more internet managers for businesses than external security analysis. The framework is useful for both. Porter in 2008 identified the following 5 determinants of intensity of competition in the industry: the threat of entry, the power of suppliers, the power of buyers, the threat of substitutes, and a rivalry among existing competitors. Although all 5 of these forces merit attention, the first 5 are particularly recommended as the first focus for analysis. The 2 factors are broadly applicable because all companies have competitors and must worry about new entrants to their industry. Also, in investigating these 2 factors, the analyst must become familiar in details with an industry's incumbents and potential entrants, and all the company's relative prospective competitive prospects. Addressing the following question should help the analyst evaluate the threat of new entrants. So, barriers of entry. Now, we learned about barriers of entry in microeconomics, about pricing power, about long-term supernormal profits, and how barriers of entry such as skill, sole control of a resource, legal monopoly powers such as patents, or economies of scale, such as in the case of, you want to build cars. It's really hard for any random Joe off of the street to build a car. You have to have economies of scale. So these are all legal monopoly powers or legal barriers of entry. Or there are also illegal barriers of entry where you basically buy up all the competitors, but industry concentration, that's another barrier of entry. Okay. Industry capacity, that's also barrier of entry. Market share stability. Yeah. So what is this? Industry cycle model. Oh, okay. Time. So an embryotic when it starts to grow, growth when it starts to grow really high, stakeout when it goes like that, mature when it starts to plateau out and decline when it grows. I really wonder where companies. Okay, so companies such as BlackBerry, they're in a decline. Companies such as like Tesla. Okay, Tesla is in the growth stage or in the stakeout stage. Companies like Apple, I would argue, is in the maturity stage. Now, this video is recorded in 2021. Of course, by the time you watch it, I may be all wrong. If you're watching this video 10 years from now, potentially you have a totally different outlook on it. But yeah, so this is the different stages of a company. All right, let's see what's next. External influences on industry growth, profitability, and risk. External factors affecting an industry's growth includes macroeconomic, technological, demographic, governmental, and social influences. We've actually talked about this. Macroeconomic influence, trends, and overall economic activity generally has significant effects on the demand or aggregate demand for industry's product or services. This trend can be cyclical, structural. It's just like unemployment in economics. It's cyclical unemployment, structural unemployment, and frictional unemployment. Unfortunately, we don't have frictional macroeconomic influences. That's quite interesting. Among the economic variables, they usually affect the industry revenues and profits in the following: domestic growth, product, interest rates, availability of credit, and inflation. Okay. Quite straightforward. Technological influences. New technology creates new and improved products that can radically change an industry and change also changes how other industries that use their products conduct their operations. And once again, you could think of this as the production possible new frontier, and how the PPC curve shifts outwards as either a capital, which is technology, or labor, and what's the third one? Capital, labor, and land, right? Capital, labor, and land. Wait, is that right? Yeah, capital, labor, and land. Those are the production, the factors of production, and technological influences shift the production possibility frontier out, and that of course influences the ability and the effectiveness for firms and companies and enterprises to compete and actually grow. Yes, demographic influences change in the population size and the distribution of age and gender, and in other demographic characteristics may have a significant effect on economic growth and on amounts of types of goods and services consumed. The effects of demographics and industries are well exemplified by the impact of the post-World War II baby boom in North America on the demographics for goods and services born between 1946 and 1964. This bulge of 76 million people in North America population has influenced the composition of numerous products and services in the need in its passage of its cradle like childhood, adolescence, early adulthood, middle age, and into retirement. The teenage pop culture of the late 1950s and 60s, and all the products, records, music, clothing, and fashion associated with it, the surge in demand or housing in the 1970s and 80s, and then increasing demand for retirement-oriented investment products in the 1980s, 90s, and 2000s are examples of the range of industry affected by demographic bulge, walking in a way through age categories of the population. Okay. Interesting example. Governmental influences. Once again, governmental influences on industries, revenues, and profits is pervasive and important in setting tax rates and rules for corporations and individual government affecting profits and incomes, which in turn affects corporate and personal spending. Governments are also major purchasers of goods and services from a range of industries. Example 10 illustrates the sudden shift in wealth that can occur when governments step in to support quash. I like that word, quash a security market innovation. An example, an income trust refers to a type of equity ownership vehicle established as a trust issuing ownership share known as units. And income trust becomes extremely popular among income-oriented investors in Canada in the late 1990s and early 2000s because under the current regulations, such trusts can avoid taxation or income distributed to unit holders or investors. That is, avoid double taxation. Ooh, I hate that word. Oof, double taxation. Yikes. As an expat living outside of the U.S. and I have to pay double taxation. Ooh, I hate that word so much. Anyways, often governments exert their influence indirectly by empowering their regulatory or self-regulatory organizations. Yeah, this makes a lot of sense. Okay. Company analysis, the spicy meatballs. Company analysis includes the analysis of a company's financial position, products and or services, and competitive strategies. Company analysis takes place after analysts have gained an understanding of a company's external environmental, macroeconomic, demographic, governmental, technological, and social forces influencing the industry's competitive structure. The analysts just seek to determine whether the strategy is primary, defensive, or offensive in its nature and how the company intends to implement the strategy. Porter identifies two chief component strategies in issuing a cost strategy and a low-cost strategy. Companies strive to become the low-cost producers and to gain market shares by offering their products and services at lower prices than their competitors, while still making profit margins sufficient to generate superior rates of return. Of course, they want to have superior rates of return based on the higher revenues achieved. Low-cost strategies may be pursued defensively to protect the market positions, and returns are offensively to gain market shares and increase returns. Pricing also can be defensive or aggressive. In the case of intense rivalry, pricing may even become predatory. Ooh, nobody likes a predatory pricing strategy that is aimed to rapidly drive competitors out of business. Ooh, we hate that. That's SEC can bust their doors off. In differentiation strategies, companies attempt to establish themselves as a supplier of producers of products and services that are unique either to quantity, quality, type, or other means of distributions. To be successful, their price premiums must be above the cost of differentiation. And the differentiating must be appealing to customers and sustainable over time. Corporate managers who successfully pursue differentiating strategies tend to have strong market research teams to identify and match consumer needs with product development and marketing. Such a strategy puts a premium on employing creative and innovative people. Elements that should be covered in company analysis provide an overview of a company, including a basic understanding of businesses, investment activities, corporate governance, and perceive strategic strengths and weaknesses. Explain the relevant industry characteristics. Analyze the demand for a company's products and services. Analyze the supply of products and services. Explain the company's pricing environment, and present the interpret relevant financial ratios. Wait a second. Doesn't it? Okay. I would actually add something to this. I would actually add potential and existing competitors. I'm actually kind of shocked that this isn't included in the section. I mean, if we're going to analyze a company, we kind of do have to analyze the flip side of the company, which is like the competitors. If we're analyzing like Burger King, it's really hard to analyze Burger King and not actually talk about or even at least consider or mention McDonald's or Subway or Five Guys or In-N-Out, right? Or Cow Jones or Cow Juniors or, I will add that to the list. Companies analysts often includes forecasting a company's financial statement, particularly when the purposes of the analyst is used for discounted cash flow methods to value a company's common equity. Yeah, so that actually makes quite a bit of sense. Okay. Spreadsheet modeling. Ooh, our fancy terminology. That's the modeling I like to see. Okay, spreadsheet modeling of financial statements to analyze the forecast revenues, operating net incomes, and cash flows has become one of the most widely used tools in company analysis. As an investment banker, you have to use a lot of the financial modeling. I mean, although spreadsheet models are valuable tools for understanding past financial performance and forecasting future performance, the complexity of such models can at times be a problem because modeling requires an analyst to predict and input numerous items in financial statements. There are risks of error either in assumptions made or in the formulas in the model, which can compound, leading to various forecasts. Yet these forecasts may seem precise because of the sheer complexity of the model. The result is often false sense of understanding of the security on the part of those who rely on the models. To guard against this, before or after a model is completed, a reality check of the model is useful. Such testing for reasonableness can be done by first asking what the few most important changes in the income statement is, and likely the last year of the year and the next year. Second, attempting to quantify the effects of the significant changes in the swing factors of the bottom line. All right, summary. In this reading, we have provided an overview of industry analysis and illustrated approaches that are widely used by analysts to examine an industry. Compare company analysis and industry analysis are closely interrelated. Company and industry analysis altogether can provide insight into sources of industry revenues, growth, and competitors' market shares, and thus the future of the individual company's top line growth and bottom line profitability. Oh, it's called top line and bottom line because in the reported or in the filed either income statement, balance sheets, or financial statements, the top line will show stuff, and at the bottom line is basically like the summary. For example, in the balance sheet, we have top line, we have the assets, we have the liabilities, but in the bottom line, we have the total enterprise value or something like that. Okay, so that's why they're called the bottom lines and the top lines. So that's just a little bit of a trivia. Another trivia I wanted to point out is like equity, right? Equity in a company. Why is it called an equity? It's because each share is equal in value to another. So one share in Apple stock is equal to another share in Apple stock. Now, that is given that our equity type is a common stock. Now, there's preferred stocks, there's common stocks, there's different types of stocks, there's controlling stocks, there's common stocks. But given that your equity value or equity is the same, one share of Apple is equal to another share in Apple, so that's why they're called equity. They're equal to each other. So yeah, that's another piece of trivia I just wanted to point out for no reason. Okay, company analysis and industry analysis are closely interrelated. Company industry analysis altogether can provide insight into sources of industry revenue, growth, and competitors' market shares, and thus the future of an individual company's top line growth and bottom line profitability. Industry analysis is useful for understanding a company or business's environment, identifying active and equity investment opportunities, formulating an industry or sector rotation strategy, and portfolio performance attributions. The three main approaches to classifying companies are product and or services applied, business cycle sensitivities, and statistical similarities. Commercial industry classification systems includes global industry classification standards, Russell global sectors, and industry classification benchmarks. Global governmental industry classification systems include industrial standard industrial classifications of all economic activities, industrial classifications of economic activities in the European community, Australian and New Zealand standards industrial classifications, and North American industry classification systems. A limitation. Wow, that's a lot of summaries. Okay. Okay, where am I? A limitation of a current classification system is that the narrowest classification unit assigned to a company generally cannot be assumed to constitute its per group of purposes of detained fundamental comparisons of valuation. A peer group is a group of companies engaged in similar business activities whose economics and valuation are influenced by closely related factors. Steps in constructing a preliminary list of peer companies include, once again, examine commercial classifications of systems if available, review the subject companies and reports of discussion of the competitors' environment, review competitors' annual reports to identify other potential comparables, review industry trade publications to identify additional peer companies, confirm that each comparable or peer company derives a significant portion of its revenue and operating profit from similar business activities as the subject company. Note all industries are created. Not all industries are created equal. Some are highly competitive. Others have so some have high barriers of entry, some low, some more profitable, some less profitable, some highly regulated, some less regulated. So that's common sense. Different competitive environments and are determined by structural attributes of the industry for those important reasons. Industry analysis are vital complement to company analysis. The analyst needs to understand the context in which the company operates to fully understand the opportunities and threats the company faces. The framework of strategic analysis is known as the Porter's 5 forces. 1 is the threat of new entrants. 2 is the bargaining power of suppliers. 3 is the bargaining power of buyers. 4 is the threat of substitutes. And 5 is the intensity of rivalry among existing competitors. Okay. The concept of barriers of entry, once again, we talked about this in economics. Once again, barriers of entry could be anything that prevents new firms from joining the marketplace. This could be patents, legal patents. It could be economies of scale. This could be sole control over a resource. It could be technology development. These are all barriers of entry. Now, industry concentration is often, not always, a sign of industry may have pricing power and rational competition. So the higher the pricing power, the higher there is a barriers of entry, and there could be assumed because there's high barriers of entries, companies can produce it closer to the MC equals MR point of production or price or revenue maximization. Profit maximization, I'm sorry. Examining the market share stability of industry over time is similar to thinking about barriers of entry and the frequency with which new players enter the industry, and industry's positions in the life cycle has a large impact on the competitive dynamics. So once again, depending on where you are in the industry cycle, not the business cycle, you will be able to see the manager philosophy, the approaches to capital raising or factors that will affect the way in which a company raises money. The useful framework for analyzing and evaluation of the industry is the industry life cycle model, which identifies the sequential stages of the industry, typically through the embryonic growth, the stakeout, the mature, and the declining phases. Price competition are thinking like consumers and important factors that are often overlooked when analyzing an industry. Whenever factors must influence consumer purchasing decisions, there are likely to be focus on competitive rivalries in the industry. Broadly, industries for prices with larger factors in which consumer purchases decisions tend to be more competitive or price elastic. Then an industry will have consumers value their attributes more highly. External influences on industry growth, profitability, and risk includes technology, demographics, governments, and social factors. Company analysis takes place after the analyst has gained an understanding of the company's external environments and includes answering questions about how the company will respond to threats and opportunities presented by the external environment. This intended response is the individual company's competitive strategy. The analyst should seek to determine whether the strategy is primarily defensive, offensive, or even predatory. Okay, and companies' pricing strategy could be predatory to competitors, and government regulation may be required, or, if we have lazy fake capitalism, then they could just go for whatever they want. Porter identifies two chief competitive strategies: a low-cost strategy and a productive strategy, differentiation strategy. A checklist of a company analysis includes the thorough investigation of corporate profiles, industry characteristics, demand of products and services, supply of products and services, pricing, and financial ratios. Spreadsheet modeling of financial statements to analyze the forecast revenues, operating the income, and cash flows have been one of the most widely used tools in company analysis. Spreadsheet modeling can be used to quantify the effects of changes in certain swing factors on various financial statements. The analyst should be aware that the output of models will depend significantly on the assumptions that are made. So this is the introduction to company analysis. Now, if anyone have actually understood economics and theory of the firm, then this will not be foreign to you. If you have background, for example, I studied a textbook by the name of I forgot the textbook name. Okay. Principles of Corporate Finance. I really recommend that textbook. I read Principles of Corporate Finance in my undergrad years, and it's really quite interesting. So the show notes are in the descriptions, and I hope to see you guys next time. Goodbye.